So a lot of times I get the question of what's changed with the 401k, and 401k is such an important and crucial piece to a retirement plan because that's where a lot of the folks can put the most amount of money while they're working. Some of the big changes to the 401k this year are it's jumping from $23,000 per year to $23,500 that you can contribute to the 401k. If you're 50 years or older, it is also jumped up for what they call the step up or the catch up period to $31,000. So every year you're going to notice that it goes up a little bit how much you can put in. And that's basically just due to inflation and things in the economy. So that's the important numbers to remember. The big important part about the 401k to me, and I don't care if you're 20 years old, 30 years old, 50 years old, or you're in retirement already, one of the focuses for everybody is going to have to be taxes at some point in their life. Most people I meet are in one of the highest tax brackets of their life in their 70s, and they never thought they'd be there. And the reason why is because they've saved most of their, if not all of their money in traditional IRAs or traditional 401ks, those tax deferred type of accounts. And that's great, but the problem is you're going to have to pay the taxes eventually. And one thing I know about taxes is they usually don't go down. Now they have here in the past. We've noticed that the 25% bracket has gone down to the 22 or the 15 has gone down to the 12. So literally taxes are lower today than what they have been in the past and what they're probably going to be in the future. So the question is, how do you take advantage of that while you can? And the 401k is one area or one avenue to try to take advantage of the tax brackets where they are today. That being said, most 401ks have a Roth 401k option at this point. It didn't used to be that way. A lot of people weren't able to put money into a Roth because either they made too much money and there was no Roth option within their employer plan. But today, for the most part, there are. So take advantage of it while you can. Maybe you're in a higher tax bracket and you're trying to defer the taxes, so you put it into the traditional 401k. But you might want to think 2 steps ahead and say, if I put the money into a Roth now, that money grows tax-free and it comes out tax-free in retirement. So if you're in your 20s or 30s, there might be no better place than to put money into Roth IRAs, 401ks, any type of Roth account that you can, because you have so much time on your side for that money to grow tax-free that once you get to retirement and you need income, you need to start drawing from some of these accounts, you never have to pay taxes on it ever again. So the 401k is such a powerful tool, again, because it's where you can add the most money while you're working. But if you can start thinking about taxes in the future and thinking about where is the best place for me to put this money today so that I'm in the best position that I can be in retirement, you might want to start looking at the Roth option within that 401k. Now, when it comes to 401ks as well, you want to look at risk. And if you're young meaning you just started working, 20s, 30s, 40s, somewhere around there, you can afford to be a little bit more aggressive in that account. The old adage is the longer period of time you have before you retire, if the market goes down, you have time to let it come back up. So the most growth you're going to see is if you're a little bit more aggressive early on in your career, but as you get closer to retirement, you want to start to scale back the risk a little bit. And not completely. I'm not saying go into all bonds or into the cash position within the 401k. But you may want to think about getting a little bit more conservative the closer you get to retiring, because it counts at that point. If you remember 2008, the market went down 40%, and a lot of 401ks went down even more than that because they were pretty aggressive. Now, if they were going to retire in the next 5 or 10 years, they might have had to push that back a little bit, because not only does it go down, but it also takes a lot longer to come back up. You know, like if you lost 10% in your portfolio tomorrow, you don't just have to make 10% to get whole again. You have to make 20% to get back to where you were before that. So if the market goes down drastically and you don't have the time to make it back, that might prolong how much you have to work. So you have to be cognizant of that. You have to know where you're at in life and where you should be from an investment perspective. Now, maybe you're not afraid of risk at all and you're saying, if it goes down, I'm not worried about it. I'll let it come back up. I know what I'm doing. That's fine. You know, this isn't going to be the right plan for everybody, but I would definitely sit down with an advisor at some point and just figure out, where are you in your life? How close are you? And are you in the right position to get you to where you need to be in the future?